Wall Street's race to 8,000 is an engineered illusion. Right now, retail investors are aggressively bidding up public indices, mesmerized by the illusion of absolute AI scarcity. The mainstream narrative tells you that the upcoming initial public offerings of SpaceX and OpenAI are the ultimate wealth creation events of our generation, a massive stimulus injection that will carry the S&P 500 to historic unassailable highs. But the math tells a different, far more dangerous story. These two mega-IPOs are not stimulus. They are the triggers for the largest structural liquidity drawdown in modern financial history. And in exactly 90 days, post-IPO, a massive secondary supply overhang is mathematically programmed to trigger a multi-billion-dollar dilution effect that will crush retail portfolios. This is how the wealth transfer happens. For the past 20 years, the stock market has been running on a very specific, carefully engineered physics engine. Public companies systematically manufactured an artificial equity scarcity regime. They spent trillions of dollars buying back their own shares. Less supply, artificial demand, valuations go to the moon. But the foundational architecture of the current boom, the artificial intelligence revolution, was intentionally built behind closed doors, in the private markets. This was done to maximize founder control and avoid the clinical scrutiny of public quarterly earnings. Now the mainstream financial networks are selling you a beautifully packaged wealth effect. The theory, early insiders cashing out of OpenAI and SpaceX will flood the economy with liquid capital, triggering a massive consumer and tech spending boom. It's a compelling story, but it ignores the fundamental law of market gravity. Institutional investors do not have infinite cash. The ultra-aggressive consensus forecasts currently demand a 14% forward profit growth rate for 2026. Let's put that in perspective. That is the highest expected forward profit growth rate outside of a recession exit since 1998. The market has priced in absolute perfection. There is exactly zero margin for earnings disappointment. But the private empires have a secret they can no longer afford to hide. The monster they built in the dark has grown too big for its creators to feed, and the true cost of their survival is going to be extracted directly from your index funds. Welcome to the liquidity drain paradox. When a mountain of private supply floods the market, it forces an immediate structural reallocation of institutional capital. For every $1 billion an asset manager needs to allocate to the new SpaceX or OpenAI listing, they must sell $1 billion of something else. They are forced to systematically liquidate and rotate out of existing non-AI equity allocations. The market assumes these companies are going public from a position of absolute strength. The reality? They are on financial life support, crushed by their own capital expenditures. The White House-backed Stargate project with Oracle projected a massive $500 billion infrastructure buildout over 4 years. But OpenAI's own CEO shattered those estimates, quietly committing to an unbelievable $1.4 trillion in data center buildouts. This brings us to the great capital contradiction. AI data center growth is violently cannibalizing the exact private cash flows and operating capital required to sustain these mega firms. The 4 major US hyperscalers, Alphabet, Microsoft, Amazon, and Meta, are projected to burn through $650 billion in aggregate capital expenditures this year alone. That is quadruple their 2023 spend. They are out of operating capital, which is exactly why, just months ago in February 2026, Elon Musk's SpaceX executed a record-breaking $250 billion buyout of his own AI startup, xAI. This wasn't about technological synergy. It was a calculated forced maneuver to weaponize SpaceX's massive operational cash flows and its forthcoming IPO liquidity to artificially fund the bottomless pit of AI infrastructure. The private tech pipeline is preparing to dump a market cap equivalent of 3 to 4% of the entire S&P 500 onto the public markets in a single year. An abrupt, violent layout of new equity supply. But the real devastation doesn't happen on IPO day. It happens exactly 90 days later, when a highly specific mathematical certainty tightens around the retail investor. We have entered the circular AI CapEx stranglehold. The scale of this financing is bordering on systemic market asymmetry. JP Morgan projects $1.5 trillion in corporate investment-grade debt will be issued over the next 5 years exclusively to fund AI. That is 1/5 of the entire US investment-grade corporate debt market. Add to that the $800 billion in private credit Morgan Stanley sees pouring directly into the hyperscaling ecosystem. Here is the exact timeline of the wealth transfer. When SpaceX and OpenAI list, institutions will liquidate legacy equities to buy the primary offering. This causes the initial index dilution, but exactly 90 days after the bell rings, the regulatory blind spot opens. Insider lockup restrictions expire. Early investors, founders, and private equity backers are legally cleared to cash out. This dumps a massive, unprecedented secondary supply overhang onto an already exhausted market. If this structural bottleneck snaps, the illusion of an unyielding equity bull market collapses. Retail investors treating index ETFs as safe havens are highly concentrated. They are overexposed in price, profit, and valuation terms to a dangerously narrow cluster of top stocks. When the multi-billion-dollar scale of these private tech IPOs functions as a giant liquidity vacuum, asset managers will execute a forced structural liquidation. What dies first? Everything at once, triggering a highly dispersed, disorderly, and unruly sell-off ripping across the S&P 500, NASDAQ, and MSCI World indices simultaneously. The very index you believe will hit 8,000 on the back of AI prosperity is the exact vehicle that must be cannibalized to pay for it. The sequence is set. The clock is ticking. You can't say, the data didn't warn you.